the bottom here. But more importantly, if you invest in the market now and you're willing to hold for the next month or 6 weeks, the likelihood that we're not going to have lower volatility and higher stock prices, this is it's a great place to buy if you can.
Why? Why now?
Well, the question is, why did volatility, if it's been sitting at 10 or 12 for the last, I don't know, year, what about the underlying fundamentals is worse? We have, recessionary risk is still contained. The business cycle is, the synchronized recovery is still in good shape. This is one of the best earnings seasons we've seen. The leading indicators like the PMIs are all telling you that we're going into more strength in the first half of the year. And none of those things have changed. So if that's the case, you should be buying it now.
Well, Tom, I don't think a lot of people would dispute that, a lot of those points that basically things haven't changed much. I think the real question is, did January just get carried away in pricing this in too aggressively or extrapolating the good news for too long? Where do you think we sit here in sorting that out?
Yeah, I think the playbook is changing, and I think that's what investors are kind of beginning to understand. We're in an environment now where I think structurally interest rates are rising. So the playbook from 1980 to now, which was always lower interest rates and growth, I think is shifting towards what really was prevalent in the 50s through the 70s, which is you want to be overweight stocks leveraged to higher interest rates, which is value style investing, and I think it's a resurgence in commodity trades. So that's the feedback we're getting from our clients, is that there's a recognition now that they can't ignore, as Jonathan said, low vol. But if we're talking about structurally higher interest rates, it's a big shift in portfolio allocation as well.
Tom, though, are we getting a little bit carried away in terms of just penciling in this upward grind in interest rates indefinitely? I just wonder exactly if we can just sort of say, well, they're going to be higher than lower over the next few decades, and somehow it's going to happen all at once.
The pace that it's going to rise is unknown, right? Core PCE, which is what the Fed watches, moves like molasses because it's pretty well anchored, and I think the chances of that breaking 2% this year, we did some analysis, less than 10%. But the markets are going to focus on wage inflation, and wage inflation hasn't led core PCE or CPI in general since the 1950s. So I think in general, markets' comprehension of what wage inflation means is still pretty weak, and I think that's why it's actually going to matter more than we realize.